So now it's probably telling you you're being recorded. Um, anyway, so I wanted to start tonight just I guess by addressing, I know the exams are hard in this class, and I'm frustrated by some of the limitations that we have, like the inability to share with people exactly what they missed. That's a department decision, not a teacher level decision. So just know that I'm one of those people who learns best often by making mistakes and then seeing what I did wrong. And then once I see what I did wrong, it makes it really stick in my head. But I don't have that authority. So the best I can do is to put out those little reports that show how you scored by learning objective, which some people find very helpful because they'll go back and review those learning objectives in the book. Others don't think they're very helpful. So it's what I can provide. And then also to say, kind of, I guess, congratulations as we move on. You'll notice that at this point, we've sort of learned about debits and credits and journal entries and adjusting entries and all of these concepts. And so those really are the foundational concepts. So when I say congratulations, I mean you've made it through the foundational things that you need to be successful. If you're still struggling and feeling like I still don't understand this stuff, then it may be worth committing some time and effort into reviewing, like if debit and credit rules are still hard, that assets increase with the debit, decrease with the credit, liabilities being the opposite. So that like when you have to make a journal entry, if that's still hard for you, I would recommend doing some practice stuff because those never go away. And you get into accounting too, or I try to remember what they call it at BYU Idaho, but the managerial accounting course, and they're still there. So those are foundations. But if you're feeling like I mostly understand it, but I'm still a little shaky because I don't use it all the time, that's the normal, regular place to be right now. So you're not expected to be experts or accountants after this course or after the second one. And if you decide, hey, I love accounting and I want to go on to it, lots of schooling ahead. It's typically a master's degree now if you want to go be an accountant. So don't feel like you have to be that expert after 4 weeks or 5 weeks in one class. So there's my preamble, I guess. It just don't get discouraged if you feel like it's not perfectly coming together. But if you feel lost still, then you may need to do some review. I'm watching this firsthand. My wife had decided she needs to go back to school. I work full time at a community college, so she can get free school there for the first 2 years. But watching her work through the basic college algebra course and struggle when we haven't taken math in 30 years and trying to help her with it when I haven't taken math in 30 years other than doing this kind of math, I feel a little bad for her, and because I barely remember those things. Our daughter's a math teacher, but she refuses to call her for help. I don't know if that's stubborn mom pride or what it is. Anyway, okay. So this, moving into this upcoming week, a lot of times people have questions about, I'm going to open up the modules here, about this. Where is it? Let me share this with you and I'll show you what I'm talking about. Okay, so here I am just in the modules of the course. Mine looks slightly different because, because it's in the teacher view, so there's all these things that say do not publish. But this ethics assignment, there's always questions about it. So let me try to just address a little bit up front, and then you can ask any questions you need. So the ethics assignment, I'm going to click on it here. It involves writing a memo, and it's kind of two parts. There's kind of an accounting part of it where we want you to kind of solve an accounting problem. And then there's a second part, which is writing a professional memo. And so I just wanted to kind of go through it, tell you what the expectations are, and then tell you a few pitfalls people hit when they've been doing it in the past. So here's the scenario. You work for a company that's begun selling annual subscriptions to its new online magazine. During December, the company sold the first subscriptions, receiving $600,000, which represents 1/5 of its revenues from all sources for the year. The entire amount has been collected in cash. As the end of the year approaches, you notice the company recorded the entire $600,000 to revenue, and there is no plan to make an adjusting entry. So with that information, they want you to write a memo about 2 paragraphs in length that explain these bullet points: the accounting error, the effect the error will have on the financial statements dated at the end of the year, the problems that might result, and the importance of fixing the error and what needs to be done in the error. Make sure to include proper grammar, spelling, etc. Okay, so the first thing I want to maybe try to explain is what's going on with this accounting problem. And so the idea is, if I receive $600,000 for services I'm going to provide next year, right? So this says in December, we've sold our first subscriptions, and let's see. And this 1/5 thing throws everybody off. It has nothing to do with anything. So that is an obfuscating line, okay? So what this is telling us is they received $600,000, and what it doesn't tell us is when they're going to start delivering the magazines to people. So I would make the assumption, reading this, that we're selling these subscriptions in December for a magazine that's going to start in January, even though it doesn't say that. But that's how I would approach this. If somebody also made the assumption that the subscriptions were going to start going out in December, I wouldn't say they were wrong. Okay, so there's room for interpretation here, I think. Anyway, so the issue here is when we receive money in advance, we have to record that as a special liability account called unearned revenue. That means money we've received, but we haven't delivered a good or a service to anybody. Okay. We don't record it as revenue until we deliver the good or the service. So for something like subscriptions, what we would do is we would record this as an unearned revenue. We would debit our cash account, so cash should be going up, and then credit unearned revenue, so the liability unearned revenue would be going up. And then when we start to deliver these magazines to people each month, okay, we would recognize a portion of that unearned revenue as revenue. So as the way I take it, this is $600,000 for 12-month subscriptions of a magazine. So I would take 600,000 divided by 12 and say, okay, this represents $50,000 per month of revenue in the next year as we deliver 1 month's worth of magazine, online magazine. So as we make 1 month worth available to our customers, then we're going to recognize 1 month of that revenue as earned. We would do that by debiting unearned revenue, $50,000, and crediting, whatever it would be called, subscription revenue or whatever. So over the course of the year, our unearned revenue would be decreasing by 50,000 each month, that liability, so that at the end of the year, it would be down to zero. And our subscription revenue would be increasing by 50,000 a month, so that by the end of the year, we'd show that we had earned the whole $600,000. So the accounting error that's been made is that we recorded as revenue something that isn't revenue yet, right? Where it's not going to be revenue until we start delivering the magazine subscriptions in the future. So that's the error. And so the effect that this would have on our financial statements is we would be showing $600,000 too much revenue for the current year. And then in the next year, when we're delivering the magazines, we're not going to be showing any revenue, even though that's when we're delivering the magazines. And so the problems that might result there is if our revenue is too high and there's no expenses with it, then we're going to have a higher net income, which is also going to increase the amount of taxes that we're paying because we're showing a net income. And so, of course, the importance of fixing the error is that we want our revenue to actually reflect products or services, in this case, subscriptions of the magazine that we've actually delivered. And since we haven't delivered any as of the end of the year, we're going to be showing too much revenue, $600,000 too much revenue. And so we need to fix that so that we're demonstrating and spreading that revenue out across the months of next year when we're actually delivering the magazine. So I went through that really fast. And so if you have questions, you can ask them, but let me give one more thing here, or one more point, I guess, is the portion of this that's writing the memo. Most of the time, the people who struggle with it do one or two things. Number one, they don't format it and write it as if it's a memo, which is what the assignment says to do. So instead, they just explain why it's wrong and then send it in. The creators of the course, so the content creators here, they want you to write a business memo. It's like, to the boss or whatever, you can call them whoever you want. I recognize this issue. Here's the steps we need to take to correct this issue, which would be adjusting entry to move that from revenue to unearned revenue, right? We could just fix that whole issue by debiting the revenue account, 600,000, and crediting the unearned revenue account. The second thing people do is, I don't know if this is like a new issue, but I've seen a lot of these over the last couple of years where they come out super aggressive as if they're like lecturing the boss on what, you made an error and that could be considered as fraud and all this stuff. And so in the financial world, we don't use the F word, okay? We don't say fraud, especially in a written memo to our boss. We assume someone made an error and we explain that we found an error and here's how it's corrected. I wouldn't start accusing people of fraud. I mean, if I sent him a thing saying this needs to be corrected, and my boss replied and said, I don't think it needs to be corrected. And then I said, well, it really needs to because here's the rules of accounting. And they said, no, we really need to recognize that revenue this year. Then I might, in an email, say, probably even before I emailed it, I'd go have a conversation where I would say something like, hey, if we're recognizing revenue we haven't earned, that doesn't follow generally accepted accounting principles and it can be construed as fraud. So we need to fix this. And then if they were like, nope, we're doing it this way, then I would finally send the letter, right? The written record that I said this was fraud if you don't fix it. And that's just because fraud's a really sensitive word in the financial industry. We don't want to accuse somebody of fraud. We want to assume people, things are honest errors, and only would get down to saying something is fraud in writing if we were at the point where we were like, this company's doing something wrong and I need to protect myself by showing that I told them in writing that this was wrong. And that's rare. That's never happened to me in my career. So anyway, okay, that's me. I talked a lot there because that's what I do. I found out there was a job where you get paid to talk. It's just like I started teaching. Anyway, so any questions about this assignment that I could try to clear up after that really lengthy speech? That must mean I'm incredibly good at explaining things. No questions. Or you haven't read it enough to really have the context you would need to ask a question yet. That'll come up later, right? As you're reading, you're like, wait, what am I supposed to do with this? That happens to me a lot when I don't know. I don't know what question I need to ask because I'm not sure yet. Okay, so that's the one thing that kind of people ask a lot about. So I wanted to put that out there. And hopefully that will help you as you go through the process of doing that assignment. I will say that this isn't an English class. I am not trying to like hit people hard on their grades. So honestly, if you write the memo and it's reasonably written and it does what it says it's supposed to do in the instructions, you get full credit. And if it's bad and doesn't do that, usually I'll send it back in with some feedback saying, if you want to resubmit for a higher score, you can. If you just want to leave it, that's fine too. In other words, I'm not trying to make this assignment be, you have a lot of stuff to learn in this course. And so I don't want someone to have to spend an inordinate amount of time on this assignment. That's why I explained the concept behind it there. And, so put together a decent memo and send it in and you'll get full credit. Or at the very least some feedback. It says, how to improve the grade if you want. So that's that for that assignment. And then that's kind of all I had to kind of say. And then I realized that took almost 20 minutes, so I apologize for how much I talked there. And so I guess I would turn it to you and say, did you ask if you had any questions about any other material this week, or specific problems you wanted to look at, or anything, any question? I mean, yes, about the mysteries of the universe. I don't know the answer. Okay.
I've started this week's assignment in the McGraw-Hill stuff. I was hoping that that you could give an overview.
Yeah, I would be more than happy to do that. Sometimes I feel like when I do that, I'm pulling it up. That's why I'm talking. It'll take me a moment to pull it up here. Sometimes I feel like when I do that, I'm just lecturing at people, and some people learn really well that way, but other people are like, "Oh, why is this person lecturing at us?" So I'm always reluctant to just launch into too much of an overview. But let's see, pull up my. It's taking a minute to load. Sorry. If I get impatient while something's loading, my granddaughter will like chastise me, and she'll say, "It's voting, Grandpa. Just wait, it's voting." So I'm thinking she gets chastised or something. I don't know why she says it with such power. Let's see. All right, now I got to figure out. I'm on my weird computer phone that has like a giant screen rather than multiple screens. All right, so I'm going to stop sharing that. Then full screen. Share. Let's see. Can you see that? Yeah.
Yes.
Okay. So, all right. So, upfront warning: this adjusting entries are hard for everybody. So don't, if as you read through them and they seem confusing, don't feel like you're dumb or something. They're hard for everybody. Hard for me the first time I learned about them, and hard for everyone else. It's like I always tell my kids, just practice something, do something every day for a job for 20 years, and it becomes easy. But in the meantime, we all have to learn. So I still kept playing guitar. So the idea is this behind adjusting entries is, because we're working with accrual-based accounting, we don't always pay cash at the time of expenses or receive cash at the time when we earn revenue. So I'll give you a few examples. Sometimes we pay in advance for something we're going to get later. I think a good example of that would be what I have right up here on the screen, where we might pay for insurance for the whole year, but we're not going to receive the benefit of that insurance until, throughout the year. So each month we're going to receive some benefit from that insurance. And so it would be a mistake to record all of the cost of that insurance, right when we pay for it. Let's say we pay in December for the next year. To record that would end up showing all that expense in December of one year, when really we're receiving the benefit of the insurance each of the months of the next year. So what we have to do then is we record that insurance as an asset called prepaid insurance. And then each month, as we use up that insurance, we record it as an expense called insurance expense, and we reduce the amount of prepaid insurance. The same thing happens with supplies. We often buy a bunch of supplies, then we use them up, spread out over the next year or next months, or however it takes us to use them. And again, we record expenses not when we pay the cash, but when we use up the asset that we paid for. So it's like in the case of insurance, we would record the expense when we actually get the benefit of the insurance. And that's called so this is called deferred expenses or prepaid expenses. So this is the first type of adjusting entry. So what we have to do is at the end of each month, for each financial period, it could be a month. Some businesses do this once a year, really small businesses. But at the end of your financial period, you have to look at any of these prepaid expenses and ask yourself, how much did I use up during the period? And then you would record the expense and decrease the asset. So prepaid expenses. So let me show you this example. So fast forward, that's the name of this company, paid $2,400 to cover its insurance for 24 months. And that began on December 1st, 2020. So when they did that, they debited the prepaid insurance account. It's an asset going up, and they would have credited their cash because they paid the cash for it. So now when we get to the end of the month, so the balance in the prepaid insurance account should equal $2,300 at the end of December. Why? Because they have the benefit of the insurance for that month. And so they're going to recognize now that they've used 1 month's worth of insurance. So they're going to enter what's called an adjusting entry at the end of December to show that they used up $100 worth of their prepaid insurance and incurred an insurance expense that month. So what this does is it allows us over the next 24 months, right, to recognize $100 a month in insurance expense and to credit this prepaid insurance $100 a month, so that by the end of 24 months, the prepaid insurance account will be down to zero, meaning we used up all of the asset and recognized it all as an expense. Instead of taking that expense all in one big lump, we recognize it as $100 each month, because appropriately that's how it was being, that's how we were incurring the expense. Okay, so it's a little confusing, but what's important about this is we recognize expenses when we incur them. And the word incur in this sense means when we receive the benefit of using up the asset. So in the case of prepaid insurance, the benefit was having insurance protection for a month. So we used up that asset prepaid insurance for a month and incurred the expense of having coverage for a month. So that is our first type of adjusting entry. And it's called sometimes you'll see them called as prepaid expenses, or sometimes you'll see them called deferred expenses, meaning an expense put off to the future. So what's confusing about these type of problems is sometimes they'll present them in more than one way. So this one, it tells us up here in the beginning part of the problem that we paid $2,400 to cover our insurance for 24 months. So they leave it to us to make the mental leap that at the end of a month, we'll have used up 1/24 of that 2,400 or $100. And so that's not a big leap. And I think, with practice, we learn how to do stuff like that. But other times they'll present the same problem and just say, they'll say something like $100 worth of prepaid insurance has expired. And you're like, wait, am I supposed to calculate something or do I just use the 100? And so that's why these can be confusing. Sometimes they'll just tell you you paid 2,400 for 24 months worth and leave it to you to figure out that you used up 100 at the end of each month. And other times they'll just tell you you used up 100 this month. And so it takes careful reading and seeing what they're asking me to do that makes these kinds of problems so hard. So now we can see at the end of 1 month, my prepaid insurance asset will now have a balance of 2,300 because I used up 100 of it. And my insurance expense for that month will have a balance, a debit balance of $100. So that's the adjusting entry to show that I used $100 worth of my prepaid insurance asset and it became an insurance expense at the end of a month. They're just showing the T accounts of the general ledger, again, to show the balances.
So one thing I'm seeing is that it's not entirely in chronological order. You can go the date of the debit and the date of the credit are different on the same line, and that's okay.
You mean here on the ledger?
Yes, and the prepaid insurance, you have December 1st and December 31st on the same line. One's a debit, one's a credit.
Yeah, with T accounts, that's fine because it's just a tool to help us find the balance of the account. You will see some people who will put each entry like on a separate line, or you'll see others who'll do it like this. And so this is fine. What this is showing, as you can see, is we had one transaction at December 1st of 2,400 that was a debit to the account, and then another one that was a credit. So them being on the same line is not an issue. Did that answer your question?
Okay, thank you.
All right.
And the other thing real fast is the adjustment, it always comes from the side that's not normal. Is that correct? Like for prepaid insurance, the normal side is debit.
Yeah, that's not always the case. So some adjustments may increase. Like for example, we debited the insurance expense, and that is the normal balance of an expense is on the debit side. So so it really does require us to say what's happening with these accounts, and then saying, okay, the prepaid insurance is going down, it's an asset, assets decrease on the credit, and the insurance expense is going up, it's an expense, and expenses increase with a debit. So yeah, I wouldn't use it as a rule that it's always on the non-normal side.
Okay.
But I will say for all of these, just so you know, there's 4 types of adjusting entries. And for all of these deferred expense ones, this first type I'm showing you, they always look the same, which is a debit to some expense account and a credit to some asset account. So they always involve that. And so if you're faced with one of these and you say, oh, this is definitely one of those where I'm now recognizing an expense that was prepaid in some way, then your adjusting entry is always going to be a debit to the expense account. You just have to figure out which account you're dealing with, and a credit to the asset account. So that helps. And the other thing is these adjusting entries will never involve cash. And it's because with adjusting entries, the cash was always paid either in advance, as in this case, or when we'll see when we get to the accruals, the cash will be paid later. And so if you're making an adjusting entry and you think it could be cash, just I just slap myself and say, no, there's no cash here. I'm not suggesting you slap yourself. That's what works for me. Probably something tied up in my upbringing. I'm not sure. Anyway, I was watching some video the other day of some kid being sassy with their parents, and I asked my wife, "Would you got popped in the mouth for that?" And she said, "Yeah." So apparently, our upbringing involved more getting smacked in the mouth for being mouthy than certainly than our children had, and now my grandchildren they can run riots. And we're going to. It's a different era. I'm not saying our era was better. I'm just saying that was the case.
It is a different world.
Parents didn't take as much crap. Oh, I shouldn't. You can't say crap on a BYU class. I apologize. Didn't much guff. All right. I don't know if guff's any better. So here's another type of deferred expense. This is supplies. So it tells us fast forward purchased $9,720 of supplies in December, and then that some of these supplies were used during the month. So again, the original entry, this isn't the adjustment, this is the original entry, be a debit to supplies. It's an asset, it's increasing. And then usually the way these problems are set up is it will tell you that some physical count of the supplies happened at the end of the month, and it showed that there's a certain amount, in this case 8,670, that were unused. And so now we have to figure out, well, how much did we use? And the answer is 9,720 minus 8,670, and that would be the amount we use, which is $1,050. So we do this in real life because it just doesn't make sense for us to keep track of all the supplies as we use them, like, writing them down in some little book or something. It makes more sense to just say, we know how much our supplies account is because of what we put into it. And then at the end of the month, we count up how much is there, and the difference is the amount we used up. And so we'll do an adjusting entry at the end of the month to show the amount we used up. Again, we debit the expense account, in this case supplies expense, credit the asset account, supplies, and that will give us a new balance. So again, this is just showing that we used up an asset, and so we're going to record that as an expense. So that's the adjusting entry for using supplies. And now we have the expense for the supplies we used. Another word for using them is we've incurred that supplies expense. And then we have the balance of our supplies asset account. And there's what the journal entry would look like. Like I said, these deferred expenses always look the same way: debit to the expense account, credit to the asset account. Depreciation is another form of this same concept. Sometimes when we hear the word depreciation, we think it means to show how much value an asset is losing, but it's not really. Instead, depreciation is the method by which we allocate the cost of an asset to expenses. So for example, if I buy a new vehicle to use for my business, delivery truck, let's say, again, it wouldn't make sense if I pay $50,000 for that delivery truck. It wouldn't make sense to take a $50,000 expense at the time I purchase it. Why? Because that asset, the truck, is going to provide benefit to the business over the next 5 or 7 years or whatever it is that we've planned for. So what we do is we allocate a portion of that cost each year during the life of that truck as an expense. So this involves us making an estimate of saying, okay, the asset, in this case, the delivery truck, has a useful life of, let's say, 7 years. And it will have some residual or salvage value at the end of its useful life of let's say we'll be able to sell it to somebody for $2,000. Then we can use that to calculate how much we should take as an expense each year, just by taking the cost minus the salvage value divided by its useful life. And then we do it. So I'll show you an example. So there's the formula. We'll learn even more about depreciation in a later chapter, but right now this is we use what's called straight line depreciation. Cost of an asset minus its salvage value divided by its useful life. So here's our example. We purchase equipment for $26,000. Has an estimated useful life of 5 years. The equipment is expected to be worth about $8,000 at the end of 5 years. Say that's the salvage value. And it says we purchased the equipment on December 1st, but it is now December 31st. So since it had a cost of $26,000, we'd say the cost minus the salvage value of $8,000 divided by its useful life. And we're going to use 60 months because that's 5 years. Okay. So we take that $18,000 divided by 60 months, and that means we're going to depreciate or recognize as an expense $300 for each month of the asset's life. That lets us spread the cost out as an expense over the useful life of the asset rather than just take a big lump sum expense right now, but then not have any expense for it in the future, even though we're still gaining benefit from the asset. So when we do that, the initial entry when we purchase the asset, see over here on 12.1, is to debit that asset equipment, $26,000. And then when we do the adjusting entry, we create a special account called accumulated depreciation. Accumulated depreciation accounts are special accounts that we link with an asset that we're depreciating. And so we'll debit the depreciation expense and we'll credit the accumulated depreciation account. The reason we do this is because we want to leave these long-term assets, or as they're called, property, plant, and equipment assets, at their cost while we recognize the amount of their costs that we're depreciating. So we always will create this special accumulated depreciation account that's linked to the equipment account. Each depreciable asset will have its own accumulated depreciation account. And accumulated depreciation is a special type of account called a contra asset. So all a contra account is an account that has a normal balance that is contra or contrary or opposite of the normal balance for that type of account. So a contra asset will have a normal balance on the credit side, as opposed to the debit side, which is what's normal for an asset account. So that again was a lot of talking. What it comes down to is we recognize how much of that cost we're going to depreciate, and then we do a journal entry at the end of each financial period to show how much we depreciated. And that journal entry is always a debit to the depreciation expense account and a credit to the accumulated depreciation, which follows the same pattern. We're debiting the expense, crediting the asset. It's just with these long-term plant assets, we like to track it with an accumulated depreciation account. And the reason is if we sell it before it's fully depreciated, then we can make it, if we sell it for more than its book value, which is the cost minus the accumulated depreciation, we could have a gain and we would have to pay taxes on that. Or if we sold it for less than its book value, we would have a loss. So there's tax implications, which is why they track it, these accumulated depreciation accounts, which is probably more detailed than we need right now. Questions about that one? I know I went into a lengthy accounting tirade, maybe.
I appreciate that. That helps clear things up. So if I understand depreciation correctly, in accrual accounting, expenses and their and the revenue and or their benefit all go in the same period. And so when you buy a long-term asset, you get benefit over it from it over a long time. So a little bit of the expense goes with each of that as well.
Exactly right. We're spreading the cost out and the expense over the useful life, over the time period when we're going to gain benefit from the asset.
Okay, thanks.
Is the accumulated depreciation account an asset?
Yes, so it's a contra asset, and you'll see how what we mean by that is you'll see how it's called accumulated depreciation dash equipment. So it's linked with the equipment account, and so it is a contra assets are always attached with an asset, and that way, unlike on our balance sheet, it'll actually show equipment $26,000 less accumulated depreciation equipment 300, and then it will show it as 25,700, which is the book value of the asset. So I don't know if that helped or not. So here's an example of what our balance sheet will look like. See, this would be after we've depreciated this asset now for 3 months. So it has accumulated depreciation of 900. Sometimes it will be listed like this, like on the left, equipment 26,000 less accumulated depreciation of 900 gives us a book value of 25,100. Other times you'll see it on a balance sheet where it just says equipment comma net, which means the equipment cost less its accumulated depreciation is just listed in one line. And so those are the two ways you'll see it reported on a balance sheet. No, it said everything else the same. Okay, so that was our deferred expense entries. They always follow the same pattern, which is a debit of an expense, a credit of an asset. Whether we're using up our prepaid insurance or our prepaid rent, using up supplies, or depreciating a long-lived asset like equipment, we're always going to see the same type of adjustment, debiting the expense, so recognizing the expense of using up that asset, using up that asset over time. All right, so let's move into the second type, which are called deferred revenue accounts. So this is kind of the example of the ethics problem I just mentioned. So when someone pays us cash in advance, we have to record that as a liability. And so if someone pays me, so I used to own a storage sheds that we rented out to people. And a lot of people like to pay for those like a whole year at a time. So it's only like $50 to $100 a month, depending on the size. So they pay me $600, and I couldn't just record that all as revenue when they paid me because I hadn't really earned it yet. Until I'd given them use of the building for a month, I hadn't earned anything. So instead, what I do is I record it as a liability called unearned revenue. It's confusing because it has revenue in its name, and you tend to think it's a revenue, but it's a liability. The idea behind unearned revenue is if someone pays me in advance, it's a liability or a debt because I either owe them the service I promised, or I would owe them their money back if I couldn't provide the service that I promised. So the original entry will be this credit to the unearned revenue liability account and a debit to our cash account when we receive cash. And then at the end of each month, we have to ask ourselves, well, how much of this unearned revenue did I actually earn this month? And so the adjusting entry will look like this: a debit to the liability account, which is decreasing the liability, and a credit to the revenue account, which is increasing the revenue. Or in other words, I've now earned some of this money I was paid in advance, so I don't owe it to the person anymore. And I've now, since I've earned it, recording it as revenue. Well, here's an example. We have a client pay us a 60-day fee in advance. covering the period from 12/27 to 2/24. So when that happened, this isn't the adjusting entry, this is the original entry when someone paid us in advance. Our cash gets debited, meaning it goes up, and our liability, unearned consulting revenue, it goes up. So as of right now, I have $3,000 in cash, and I owe my customer $3,000 worth of consulting services. They paid me in advance, but I haven't earned any of it because I haven't. So I just owe it to them. So then it tells us fast forward earns payment as time passes. At December 31st, 5 days services is earned, or 5 out of the 60 days. So to figure out how much we've earned, if they're paying me $30,000 or $3,000 for 60 days worth, and I've now earned 5 days worth, I'll take 5 over 60 times the $3,000, and that gives me $250 that I will have earned as of the end of the month. So now I'll do an adjusting entry to show that I've earned that money. And so I'll debit consulting revenue. I'm sorry, I'll debit unearned consulting revenue to reduce the amount of liability, and credit consulting revenue to show that I've earned that money. That 5,800 there is just a balance they had from before, so don't let it confuse you. So now, as of the end of the month, I can show that I still owe my customer $2,750 worth of consulting services. And my income statement will show the revenue I'd earned before, plus that $250 of unearned revenue that I earned the last 5 days of the month. So the journal entry will look like this, and all deferred revenue journal entries will look this way: a debit to the liability of unearned revenue, which is a decrease to that liability, and a credit to the revenue account. So again, this is just recognizing money I was paid in advance for but hadn't yet earned is now being earned. Sorry if you hear my dogs there. Our neighbor's dog had a bunch of puppies that have now gotten old enough to wander over here and make our dogs mad. It's terrific. Especially at 3 in the morning. I love it. Any questions about this one?
No, but I see
Okay,
why
I
you're saying it's not always the norm, the opposite of the normal account. So that makes sense.
Heather, I could see you were ready to say something.
Okay, so I'm just getting the concept of the adjustments. So it's kind of like you have a pot of money, and you're going to take some of the money and move it. So all of the adjustments is I'm taking it from here and I'm moving it here.
Yes, I'm recognizing that this money that was unearned has now been earned on the basis of, like in this case, me providing 5 days worth of services for them. So now I've earned 5 days worth of that money.
Okay.
And with the expense one, it's the same idea. I'm now recognizing that these things that were assets have been consumed or used up. And so I'm going to recognize them now as expenses, decrease the asset. Yeah, that's all we're doing. Because what happens is we get to the end of the month, and most of our transactions were fairly straightforward. But then there's always these weird ones that require adjusting, where we have either earned money that we were paid in advance for, or incurred expenses that we had paid in advance. And so we have to recognize that. That's all we're doing. Does that help?
Thank you. Yeah.
All right. 2 more, and these will go faster. The first one's the worst. So these are the first 2 were called deferrals. We had deferred expense and deferred revenue, and the second 2 are accruals. And we know that the word accrue means to sort of save up or to gain money or to gain something over time, right? We can accrue goodwill by being really nice to our neighbors. That your dogs run over, it's easy to talk to them, or whatever. So that was a totally random example, not based on anything happening. Accrued expense are costs incurred during the current period, but that we're not going to pay for until a later period. So the most common one is like our employees working. Each day they work, I owe them money, right? Each hour they work, I owe them money, but I won't really be paying it until the next payday. That's fine if the next payday happens to be during the current accounting period. But often, if we pay people like every other Friday, which is pretty normal, we'll get to the end of the month and realize, okay, they've earned some money. I need to show that as an expense this month because they earned it during this month, but the next payday is not till Friday, right? Which would be into the next month. So accrued expenses are costs incurred in the current period and are unpaid and unrecorded until we recognize them. You'll notice the dates on all of these adjusting entries are always the last day of the month because that's when we do the adjusting entries. It's at the end of the month to recognize these deferred revenues and expenses and accrued revenues and expenses as of the end of that month so that we can have them on our financial statements for that month. Okay, so accrued expenses are always a debit to an expense, increasing the expense, and a credit to a liability, increasing the liability. So here's an example. We pay our employees $70 per day or $350 for a 5-day work week. That's some pretty cheap employees. I'm guessing the owner works full time and then just has a part-timer that helps. Salaries are paid every 2 weeks on a Friday. So at December 31st, it's a Wednesday. So 3 days of salaries are owed at the end of the year, which equal $210. So we have to do an adjusting entry to recognize on our financial statements that we have incurred this expense of $210, even though we won't be paying it till the next payday. Because we've got to have all the expenses incurred during this month on our income statement for this month, or it won't be accurate. So our adjusting entry will look like this. We'll debit salaries expense, credit salaries payable. The adjustments for accrued expenses always look the same, debiting an expense, crediting a payable, a liability. And it's a liability because I owe them that money until I actually pay it to them. So we'll see our salaries payable increase by $210, and our salaries expense will increase by $210. Again, that $1,400 is just the previous balance of that account. It's part of this problem. Too many, let's see. Then at the next payday, so in this case, January 9th, we'll actually pay our employees. So we'll have to, what we'll do is we'll debit the salary payable, the amount that we owed them from December, that they'd earned in December. And we'll debit salaries expense for the amount that of the expense incurred during January, from January 1st to January 9th. Then we'll credit our cash for the total amount. So if you remember with the deferrals, the cash moved ahead of time. We either paid for the expense by buying an asset like prepaid insurance ahead of time, and then we were recognizing the expense when we used up some of that asset, or in the case of the revenue, we received the cash ahead, right, and recorded as unearned revenue, and then the adjustment showed that we'd earned some of that revenue. With these accrued expenses, it's the opposite. We're recognizing the expense up front, and then the cash will happen later. And so when payday actually comes, we'll actually pay our employees and reduce that payable from December amount and debit the expense for the January amount and pay them the total amount. Did that make sense, or was it add confusion. Or both. It sort of made sense and sort of doesn't.
I'm not sure that I have it, but I can go back and review.
Okay. So last one, accrued revenues. These are revenues we earn during a period, but we're not going to receive cash until some future period. Certain types of businesses, especially like professional businesses like attorneys, CPAs, they often, what they'll do is just sort of keep track of the services they provide for someone during the month. And then when they get to the end of the month, they'll tally all those up and send a bill to the customer, right, for the amount of work they did for them that month. And that even happens in other types of services too. So same idea, as we provide the services to our customers, we are earning revenue, but we won't get paid until we bill them, and then they'll send us payment. So at the end of the financial period, what we have to do is sort of tally up how much our customer owes us and do an adjusting entry. And it will always look like this, where we'll debit an asset, and almost always the asset is accounts receivable, money owed to us by our customers, and credit a revenue account to show that we've earned it. So let's look at an example. On December 12th, Fast Forward's customer agreed to pay $2,700 on January 10th of next year for future services over the next 30 days. So on December 31st, we will have earned 20 days worth of those services. So again, we're going to say, okay, 2,700 was for 30 days. So if we worked 20 days for them, we've earned 1,800, and we need to record those for December because that's when we earned them by providing the services to them. So we're going to do an adjusting entry to increase our revenue account by crediting it, and we're going to increase the accounts receivable account by debiting it. So again, we're just recognizing we haven't been paid in advance for this, so it's owed to us. That's an asset, accounts receivable, and we've earned it. At the end of the day, all of these adjusting entries have the purpose of making sure our revenues and our expenses are correct, that they show all of the revenues we've earned during the financial period and all of the expenses we've incurred during the financial period, even if we either were paid in advance for those, or if we're not going to be paid until later for those. We need to make sure they're all current as of the end of the period so that we can create our financial statements and they'll be correct, right? We'll show the revenue we've earned and the expenses we've incurred during the period. That's the purpose of all of these 4 types of adjusting entries. So accrued revenue accounts or adjusting entries will always look the same. Debit to an asset, typically accounts receivable, and a credit to a revenue account. We'll have the balances. Again, consulting revenue had a balance previously, and the amount that we just adjusted was 1,800. So that will be accurate for the end of the month. This is one more example of the same idea. So accrued revenue at the end of one period results in a cash receipt in a future period, or not one more example, but just showing you how this will resolve when they actually pay us. So again, remember the deal was for $2,700. We provided 20 days worth of that during December. So we recorded that as a revenue and an account receivable at the end of December. And then we're going to earn the other 10 days worth of that consulting revenue during January. So that when they actually pay us on January 10th, 1,800 of it is to recognize the paying of the receivables from the money we earned back in December. And the other 900 of it is to show the amount of revenue we earned during January. So that's how that resolves.
So the split adjustments, there's one for each period.
Yes.
And that's why you can't do just 30 days. Is that correct?
Sorry, why you can't, you do the adjustment at the end of each financial period. So if the financial period's a month, then yes, it would be 30 days.
So my question then is, why two adjustments?
But there's only one adjustment, which is back here. I have too many.
Okay,
So this is our adjustment. The debit of 1,800 and the credit of 1,800 to recognize those revenues we'd earned at the end of December or in December. And then this other journal entry here is not an adjusting entry, but it's the actual cash entry when they actually pay us.
I'm trying to figure out why split it to 20 days and 10 days.
Because we earned 20 days worth of that revenue in December. And so we needed to recognize that in December. And then the other 10 days worth of that revenue we earned in January. So the financial period for this company is a month. And so if we're earning this money spread out across 2 months, we need to do an adjusting entry at the end of the first month, which was December, to recognize the amount we earned in December. And then in January, when we get paid, we're going to recognize the amount that we earned in January and pay off the account receivable that was created when we recorded the fact that we earned that other money back in December. We need to show the revenue in the month we earned it. Still not helping, huh?
So the revenue is recorded in the month we earn,
Uh-huh.
and the accounting period is by calendar month.
Yes, in this case, and for this whole course, so yes.
And so it looks like this adjustment is over 2 months because it's January and December.
So what we would call the adjusting entry is one that occurred at the end of December because we hadn't yet been paid the money, but we still needed to go ahead and recognize that we had earned that revenue during December. Then we're closing this out when they actually pay us in January. So this might be a semantic issue. The adjusting entry is the one at the end of the month where we are recognizing, in this case, the revenue earned during that month, even though we haven't been paid for it. When we actually get paid, we're then just recording, like, let's say, for example, we had earned the full amount during January. Then we would have just debited full amount, 2,700. So we would have just debited cash 2,700 and credited consulting revenue 2,700. No adjustment needed. But because we earned a portion of it in December, but we weren't getting paid until January, we had to do this adjustment that showed debiting the accounts receivable, meaning money owed to us, and crediting the consulting revenue in December. And then when January 10th came and they actually paid us, we could debit the cash, get rid of the account receivable, and recognize the amount of revenue earned during January. So it was the fact that we were earning this money spread out over 2 months that required us to adjust at the end of the first month to show the amount we'd earned. Did that help or no?
I think it's dawning on me.
Yeah, and honestly, I always feel like doing this is like trying to explain a new game to somebody, and like, I don't know, when someone tries to explain a game to me, I'm like, I don't know. Then you play a few practice hands or whatever, and you're like, oh, okay, that makes sense. So
Agreed.
practice just will help, the explanation will help. So that's the And I know it's probably more than you asked for. You know, you said you wanted an intro or a forget what you said, an overview, and went for like an hour. So I hope it was helpful. I hope it was a good use of your time.
Yes, thank you.
Any other questions or thoughts before we finish up? All right. Anybody willing to offer a closing prayer? I said the starting ones though.
I guess I'm the one that's talked second most, so I will.
Okay. Thanks.
Our Father in heaven, we are grateful indeed for this time that Brother Fox has set aside to help us with the accounting course. We thank thee for his generosity and for thy spirit that does teach us the subject beyond our own abilities. We thank thee for being able to expand our skills to be of use to thee. We are grateful for the gospel and the atonement of Jesus Christ. And this we pray in his name. Amen.
Thank you.
Yeah.
Have a great night. And if you get stuck somewhere, don't be afraid to reach out. I'll do my best to help.
Thank you.
Thank
Brother
you.
Fox, I have a question when you're
Okay.
finished recording.
Oh, you want to, okay, just a second. I'll stop recording. Unless it's a question that's going to help other people.